Hey everyone, welcome back to Corporate Decoder, the place where we dissect the dry documents of corporate America and turn them into something you can actually understand. Today, we're diving into Structure Therapeutics' latest 10K, their annual report. This one's got a bit of everything, promising clinical trials, some heavy spending, and a market that's basically a battlefield. Let's see if they can navigate it all, and maybe, just maybe, we'll find out if their stock is as good as their science. So, Structure Therapeutics, ticker symbol GPCR, just filed their annual report. If you haven't heard of them, they're in the super competitive world of obesity and diabetes treatments. They're trying to make oral, small molecule drugs, which, if they work, could be a game changer compared to the injectable medications that are currently popular. Let's get into the good news first. Their main drug, aleniglipron, showed some pretty promising results in phase 2 trials. They saw a significant, roughly 6% weight loss in patients after 12 weeks compared to those taking a placebo. And that's not all, a tablet version of the drug showed even more weight loss, almost 7%. The goal in that space is to help people lose weight, so those initial numbers look good. Now, those were phase 2 trials, meaning they were relatively small, so the real test will be in the larger, phase 3 trials coming up. Speaking of phase 3, they've already started a couple of phase 2 studies called Access and Access II to figure out the best dose for aleniglipron. Those studies are fully enrolled, and we should see the results towards the end of next year. The idea here is that oral medications might be easier for people to stick with long-term compared to those injectables, but they have to be just as effective, safe, and convenient. That last part, convenience, is one of the biggest challenges. One of their competitors, Rybelsus, which is an oral GLP-1, comes with a very complicated dosing protocol, so Structure is hoping they can make something simpler. But they're not just putting all their eggs in one basket. They are developing drugs for type 2 diabetes, heart failure, sleep apnea, and a few other chronic diseases. This also gives them multiple ways to make money, because different diseases mean different markets and different pricing strategies. Another drug they're working on, called ACCG 2671, is targeting amylin receptors. That's another approach to tackling obesity, and the company thinks it could be a good combination therapy with aleniglipron. Structure is also exploring potential future combination therapy. These include small molecule candidates targeting GIPR and GCGR receptors, each designed with customized properties to achieve additional benefit. Finally, the company is evaluating APJ with ANPA0073 to be used in combination with weight loss medicines for selective or muscle-sparing weight loss. How are they doing all this? Well, Structure Therapeutics is really betting on their drug discovery platform. It's based on understanding the structure of these receptors at the molecular level, using fancy techniques like cryo-EM. They're partnered with Schrödinger, a company known for its expertise in computational chemistry, to design molecules that bind to these receptors in just the right way. This is a hot area with lots of companies using AI and computational methods to find new drugs. Structure is trying to stay ahead of the curve. They believe that using both structure-based drug discovery and AI puts them in a great position to win. The key here is oral availability. They want to make pills, not injections, to tackle these diseases. That's a big deal for patients and for mass production, assuming, of course, that the science works out. Now let's talk about the market. Obesity is huge. Structure Therapeutics estimates it at over $100 billion annually. Diabetes, heart failure, other areas they are targeting are also massive markets. This is why there is so much competition and so much money being poured into these efforts. And competition is one of the biggest risk factors for them. There are already approved injectable drugs like Ozempic and Wegovy, which are blockbusters, and tons of companies are working on new treatments. Structure needs to prove their oral drugs can be just as good or even better to stand out. That's a tall order. Another risk, manufacturing. They don't have their own factories. They rely on third-party manufacturers, including some in China. Geopolitical tensions, trade restrictions, anything that disrupts that supply chain could really hurt them. They note that the BIOSECURE Act, aimed at limiting U.S. government contracts with certain Chinese biotech firms such as Wuzai Aptech, could potentially disrupt their supply chain, as Wuzai SDA is one of Structure Therapeutics' suppliers. To counter this risk, the company has started working with supplies outside of China in case it needs to make a shift. They also depend on research and development tax credits from their operations in Australia. If they can't get those credits, or if they lose the ability to operate in Australia, it'll hit their bottom line. And like most biotechs, they need a lot more cash. Developing drugs is super expensive and they're burning through money quickly. They say they have enough cash to keep going until 2027, but that doesn't include the really expensive Phase 3 trials. So more fundraising is likely on the horizon, which could dilute existing shareholders. Another risk is that their financial results could be all over the place, making it hard to predict how they'll do. Drug development is just that unpredictable, and any small thing could throw a wrench in the gears. Now for the numbers. As of January 31st, 2025, there were 172,028,543 ordinary shares outstanding. Keep in mind that was the total number, with over 162 million held as ADSs. Looking at the balance sheet, they have $883.5 million in cash, cash equivalents, and short-term investments. That sounds like a lot, but remember they burned almost $123 million this past year, so it won't last forever. Most of their spending, as expected, is on research and development, costing them about $109 million for the year. General and administrative expenses are about half that, at $49 million. The net loss for the year was about $122.5 million. These are the financials: high expenses, not unexpected, and a still strong cash position. They need to convert that cash into successful drugs to make it worth something. There's also a section on cybersecurity. The company is worried about cybersecurity. After all, they have lots of intellectual property and sensitive data, so they do engage with third parties to identify and assess and manage material risks. This is always a major challenge for every company, and they should continue their vigilance here.